I'm Dennis Tubbergen. You are listening to the Retirement Lifestyle Advocates radio program. Glad you decided to tune in today. Hey, joining me on today's program in the second and third segments is Dr. A. Gary Shilling. Dr. Shilling is a returning guest here on the program. He publishes a terrific newsletter titled Insight. You may recognize his name as well as a long time, as in about 4 decades or better, Forbes columnist. So he'll be joining me again in the second and third segments of today's program. And we'll get his take on what's going on in the economy, his forecast for stocks. And let me remind you, before I give you my forecast for stocks moving ahead, that we do have a website that is loaded with free resources. You can go to retirementlifestyleadvocates.com. You can sign up for our free newsletter there. You can also listen to the podcast version of this radio program there as well. And again, that website is retirementlifestyleadvocates.com. Next week on the program, I should have an announcement about my new book. It's titled Revenue Sourcing, and it's a planning strategy for the post-pandemic economy. So we're going to make that available to listeners. Make sure that you tune in next week. I'll have an announcement on that book's release. So let's talk a bit about stocks. You know, there's no shortage of opinions as to where stocks go from here. There are those analysts that are anticipating a V-shaped recovery. Other less optimistic analysts are looking for a U-shaped recovery. And then there are the pessimists that are looking at an L-shaped recovery. Well, it seems like when you look at what's been happening in stocks over the last 6 weeks or so, that stocks and markets are maybe getting a little bit more normal, to use that term, although I think we would all agree that nothing really seems normal today. I believe that what we're seeing in stocks at this point is simply the calm before the storm. In other words, I view the current rally as a counter-trend bear market rally that will die out at some point before the next wave down begins. Now, Market Watch published an article just this past week, and I'm going to give you just a bit from this article. It says, U.S. stocks are trading at pricier valuations relative to corporate profits than at any point since the dot-com bubble in 2000. The large cap index, again referring to the S&P 500, is trading at more than 22 times expected 12-month earnings, a level not seen in roughly 20 years, according to FactSet. Now, Jeff Buchbinder, who is quoted in the article, he's an equity strategist at LPL Financial, said, "We are encouraged by the stabilization of new COVID-19 cases and the massive stimulus put in place. However, stock market valuations are no longer as attractive." He added that a correction of 10 to 15% would not surprise them. Now, if you take a look at earnings, and earnings are really the driving force behind stock prices, earnings are expected to fall for S&P 500 companies in 2021. Was expected back the first part of March that earnings would be $194 per share. However, now the consensus is that they'll fall to about $150. So if you have a decline in earnings, what that means is the price-to-earnings ratio is going to go up, and stocks are going to be valued at even higher multiples. Now, for those of you that are not familiar with a price-earnings ratio, it is simply the price of a stock divided by the earnings per share of a stock. So in simple terms, the question you ask yourself is, how many dollars do I need to part with to get back $1 in earnings? And right now that answer is 22. Now, that number is likely going to go up because earnings are going to go down. That will be a driving force downward for stocks. I have long advocated that we would see a Dow to gold ratio of 2. Now, I realize that sounds extreme, and for those of you who are not familiar with the Dow to gold ratio, it is simply the price of the Dow Jones Industrial Average in U.S. dollars divided by the price of gold per ounce in U.S. dollars. So a ratio of 2 would mean that the Dow has to be at 5,000 and gold would have to be at 2,500, or the Dow would have to be at 10,000 and gold would have to be at 5,000. I know that sounds extreme. However, when one looks at history and tracks the Dow to gold ratio going all the way back to 1913 when the Federal Reserve was founded, at every major market bottom we have seen a ratio of at least 2 and a couple times 1. So this is not without historical precedent. And that's what we do here on this program, is take a look at different times in history when economic conditions look like they look today, and then we apply what happened then to what might happen now. Now, the only way that I think stocks do not decline from here is if the Fed policy becomes even more extreme. Now, I have been discussing here on the program that the Fed really has begun to manufacture money to buy junk bonds directly and buy via a special purpose vehicle used by the U.S. Treasury corporate bonds. So in essence, what this is doing is nationalizing corporate bonds to at least some extent. Now, if the Fed were to expand that to buying stocks, then all bets are off. We could see the stock market go much higher, but then we have a currency issue. At a certain point, faith in a currency, history teaches us, is lost when enough new currency is created. And it appears that there will be more new currency created because there are a lot of new stimulus proposals, again, being floated in Washington. I call them a money for the masses program. Senators Kamala Harris, Bernie Sanders, and Ed Markey have proposed a bill that would pay each American $2,000 monthly. The $2,000 monthly payments would be made to each adult family member, as well as each child in the family, up to a maximum of 3 children. That means a family of 5 would get $10,000 monthly. The bill would also block debt collectors from seizing payments to pay back bills. You can't make this stuff up. And of course, there is an elephant in the room. The question is, from where will the money come to pay for such a utopian fantasy? Well, the answer is the same place that it's been coming from. The money creation machine that we've come to know as the Federal Reserve. Now, here's the harsh reality. This is just math. I would ask that you don't shoot the messenger. When you double the money in circulation, you have its purchasing power. When you double the money in circulation, you cut the purchasing power of that money in half. It's that simple. When you continue to print money with a blatant disregard for economic reality, you eventually destroy a currency and the savings and investments of those that put their faith in the currency. History teaches us this over and over again, and in the last segment of today's program, I'm going to give you a couple historical examples, so certainly stay tuned for that segment. Now, evidently that history has not been taught to those eagerly awaiting the next round of free money from the government. But if you have some saved money, perhaps in a 401k or IRA, or maybe you've inherited some money from a hardworking parent who's passed on, you need to know this history and you need to plan accordingly. That's why for the past decade, I've advocated a 2-bucket approach to managing assets. 1 bucket to hedge against a deflationary collapse, which is, as I just discussed, what I expect to see happen to stocks. And another bucket to hedge against future and ever-increasing money creation. You need to have both outcomes covered or you risk damage to your portfolio. There are more resources available at our website, retirementlifestyleadvocates.com. I would encourage you to check it out. And I'd also encourage you to stay tuned because I'll be back after these words with my special guest today, Dr. A. Gary Shilling. Welcome back to RLA Radio. I am your host, Dennis Tubbergen. Joining me on today's program is returning guest, Dr. A. Gary Shilling. Dr. Shilling publishes a newsletter that is must-read, in my opinion. The newsletter title is Insight. It's a comprehensive 30 to 40-page report. He publishes this every month, and it's one of the best economic overviews available, in my opinion. So I'd encourage you to check it out. You can go to the website, agaryshilling.com. That's www.agaryshilling.com. Shilling is spelled Shilling. Or you can call his office, 888-346-7444. And Gary, welcome back to the program.
Oh, I'm glad to be back with you, Dennis. Always a pleasure.
Well, it's always a pleasure to chat with you and get your insight as well. No pun intended, but that is the name of the newsletter. Let's start with your headline for the May newsletter. Rather scary. Is this 1929 all over again? And boy, it sure looks like it. What's your take?
Yeah, I think there's a lot of similarities. In 1929, there'd been a huge rally in stocks in the 1920s, the Roaring 20s. The Dow Jones, which was the standard of the time, was up 600%. But then in September 29, for 2 months, it had a sharp decline, 48%. Well, after that, everybody thought everything is fine. It knocked some of the fluff of the 20s off. We're ready for bigger and better things. And stocks actually rallied back 52% of their decline, retracement. But then, as people began to realize that the depression was starting and was going to be very deep, stocks resumed their decline. They really pretty much a straight down decline until July of 1932. Total decline 89%. Now the parallel today is that we had a 500% increase in the S&P after the Great Recession, starting in 2009 up until February 19th was a peak this year, and then with the virus, the great fear was there, and stocks declined. The S&P declined 34%. Well, everybody at that point thought that everything would be under control, that we were going to see some vaccine rapidly, that things were going to reopen, and stocks retraced 55% of that decline, and that's where we are now. But in my view, we're really going to see the second leg down, very much like in the Depression. Not that severe necessarily, but what we have this time is discounting the very severe recession. I think it's going to last into next year, and as a result, I think stocks could fall from here 30 to 40%. You have the supply side disruptions, trying to get people back to work, businesses open, worldwide economic activity refigured. It's going to be a long haul. This is the greatest shock to the world economy, in my view, since World War II.
Gary, you look at some of the indicators, and you talk about in your Insight newsletter unemployment. You talk a little bit about what the current unemployment rate is, and talk about where are we going from here? Have we seen the worst of it? Does it get worse from here? What's your take?
I don't think we've seen the worst. Now the recorded number, the headline number for April, which was just reported last Friday, was 14.7% unemployment. But that underestimated it because people dropping out of the labor force, they just said, I give up, I can't find any work. They're not counted. And if you put all those in and include people who didn't check the forms correctly on the questionnaires, the rate was actually 19%. Now, in the depths of the Great Depression, it got to 25%. We're not there yet. But I don't think we're through with this because you're seeing continual layoffs. And, of course, one of the interesting things now is it is advantageous for a lot of people to be laid off because they're collecting not only state unemployment insurance, but an extra $600. And for a lot of people in this country, people who are flipping hamburgers or cleaning houses or so on, they're making more on unemployment than they were when they were working.
So, Gary, what do you see happening? I mean, we are, the United States economy is very dependent on consumer spending, you and I going out and consuming. What's happening as far as consumption?
Well, consumption took a huge decline in recent months, and the saving rate jumped up. And I think that's where we're going, is that people are going to be saving a lot more of whatever income they have. This was a huge shock. The Federal Reserve statistics show that the majority of people in this country don't have $400 in cash reserves to cover contingencies. $400, that doesn't take you very far in today's economy. So I think that this shock is going to cause people not only to be very slow to come out of their houses and go to restaurants and travel and bars and so on and so forth, but also to save a lot more money because they realize that they was very, very undersaved. So you have a number of detrimental effects on consumer: the fear, the lack of zeal to go out, the slow opening of the economy, people getting used to being at home. A lot of people, I think, found that wasn't such a bad idea. They got to know their kids better and maybe their spouses as well. But also the idea that they'll want to save a lot more money than they did earlier and build up some assets that they sorely need.
So, Gary, in your Insight newsletter, and if you're just joining us, we're chatting today with Dr. A. Gary Shilling. Dr. Shilling publishes the monthly Insight newsletter. You can learn more at www.agaryshilling.com. I would encourage you to check it out. So this kind of dovetails into the last item we just talked about, Gary, but in your newsletter you talked about consumer confidence, and you had an indicator in there that consumer confidence, I think the term you use is that it's nosediving. Talk about that, and won't that be a big hindrance to the V-shaped recovery so many pundits are forecasting and so many people are hoping for?
Yeah, well, consumer sentiment has definitely been hit hard, and the whole shock of people being locked up, not being able to go out, fear of the virus, the knowledge that more people are dying every day, and of course, the politicians want to reopen the economy, and that's true of Washington, and it's also true of the state level. But people are really fearful. They don't really want to comply with that. So I think we do have a distinct decline in confidence, which is probably going to be with us for some time.
So, Gary, when you take a look at the response, stimulus packages, I think the Fed expanded their balance sheet by over 40% in 1 month. That's just remarkable when you stop and think about it. You wrote a book called The Age of Deleveraging, which basically talks about the deflationary effects of a lot of debt. Now, with this response by the Fed, have you changed your position on that?
Well, not really, because the debt is at the federal level. And, of course, a lot of people figure that with the huge increase in the Federal Reserve's balance sheet, knocking interest rates down to zero, and then this massive fiscal stimulus, the aid to small businesses, to individuals, everybody in sight, that we're going to have this V-shaped recovery, that we're going to have the economy coming back in the second half. And that's very much in parallel to what happened in 1929. September to November was a decline, and then into July of 1930, everybody thought the thing was well. And I think we're in that similar period. But the point is that all this monetary and fiscal stimuli, I don't think is going to overcome the effects of the closing up the economy and the fear factor. Bear in mind that we had massive monetary and fiscal stimuli after the Great Recession. That's when the Fed, again, knocked interest rates down to zero, embarked on quantitative easing, and we saw a huge fiscal stimulus package, tax cuts, tax rebates, money to keep teachers hired, money for new highway construction and so on, the so-called shovel-ready projects. And that amounted to 6% of GDP. Now, we're over that now, but bear in mind that back then, the housing collapse that really was the guts of the Great Recession affected relatively few people. People who had speculated in housing thought they were going to make a killing. They got absolutely hammered, and it did spread to everybody else. But this time, the whole thing affects everybody. It just isn't it just isn't focused on a relatively small group. So I think with all this monetary and fiscal stimuli, it still is not going to give us that V-shaped recovery. But that's what the consensus believes, and I think that's what's been reflected lately in the stock market rebound.
Yeah, and Gary, there's certainly this whole situation is bringing to light the fact that there's a lot of states out there that are just flat broke. They've got underfunded pensions. I'm thinking about the state of Illinois, but there are others. In fact, I think you mentioned in your newsletter that Majority Leader of the Senate, Mitch McConnell, made a comment that states should be allowed to go bankrupt to deal with their debts. Do you think that's going to happen, and how do you see this impacting pensions and state liabilities?
Well, states going bankrupt, I think there's some legal restraints to that. I'm not a constitutional lawyer, but I think there are. Now, Puerto Rico went bankrupt, but that's a territory. That's not a state. But what McConnell is getting at is a lot of states have really had no fiscal discipline. Illinois, New York, New Jersey, Massachusetts, California. They build up huge pension fund liabilities. And now the question is, how are they going to fund them? Because they were figuring on their stock portfolios, their whole portfolios rising about 7 or 8% a year. Well, I don't think that's in the cards in the foreseeable future. Quite the opposite. And so they don't have the gain in their portfolios. So they have three choices. None of them very attractive. One is to go to the states for more money. Well, the states are really pressed now. Tax collections are down. Expenses for welfare, Medicare, Medicaid are up. They're not going to come through. The second one is to restrain benefits. That's very hard to do, but there's probably going to be some there. And the third one is to ask current employees to contribute more. The latter two, there's probably going to be some of that, and maybe a gradual working out of this. But what some states have been doing in cities in recent years is to move away from what are called defined benefit plans. That's where the company, the state, whatever, provides a pension upon retirement, so much a month for life. The employer doesn't have to do anything. They're moving to defined contribution, which are like 401k plans for in the private sector, and that's where there's a set contribution, and the employee can decide how it's going to be invested, and at the end of the day, what they have is theirs, and there's no additional funding from the governmental body. So I think there's going to be a lot of pressure to move in that direction. I don't think we're going to see bankruptcies, but we're going to see a lot of strained states and local governments.
Well, our guest today is Dr. A. Gary Shilling. Dr. Shilling publishes the newsletter Insight. You can learn more at agaryshilling.com or call his office at 888-346-7444. The number again is 888-346-7444. I will give that again in the next segment when I continue my conversation with Dr. A. Gary Shilling. Stay with us. I'm Dennis Tubbergen. You are listening to RLA Radio. I am chatting today with returning guest Dr. A. Gary Shilling. Always a pleasure to have Gary on the program. Gary publishes a newsletter that in the current economic and financial environment I would consider to be must-reading. The newsletter is Insight. We are chatting today with some topics from his May newsletter. If you'd like to learn more, you can call his office at 888-346-7444 or visit the website agaryshilling.com. So, Gary, in the last segment, you provided your view, I think I could even say forecast, that there is going to be a lot more downside for stocks here. So let me ask a question. If someone today has a nest egg that they're trying to manage, what kind of advice are you giving your clients?
Well, we are registered investment advisors, as you know, Dennis, and we do manage other people's money, and I can tell you what we've been doing with it. And by the way, so far this year, we've had very good results because we were really prepared for this. The economy was really slowing starting late last year. Many people didn't want to admit it, but it was, and we figured it wouldn't take much to tip it into a recession. And, of course, then the virus came along and did precisely that. So we were really prepared for it, and we had a fabulous I mean, we had a great decade in the first quarter in our investments. But what we did and where we are now is we are long Treasury bonds. They're the safe haven. We're in an environment that is probably more deflationary than inflationary, and there's a very high correlation between inflation and Treasury bond yields. And of course, if yields go down, prices go up. As you know, I've been a fan on long Treasury bonds since 1981 when I said in print, we're entering the bond rally of a lifetime. And since then, long-term Treasury bonds have outperformed the S&P 500 by six times. Well, we're sticking to that because I think we still have further lower rates. Whether they're going to go negative or not is a question, but I think still lower, and lower rates mean more appreciation. The second thing is that we're long the dollar. I think the dollar is a safe haven. Again, it's where people go in times of trouble, and I rather suspect that we're going to see further strength in the dollar. The third thing is that we're short stocks. We're top down. Our investment strategy starts with the economic, political, financial spheres, develops a forecast, and then sees what investment themes drop out. And whether it's commodities, stocks, bonds, currencies, long, short, we don't really have any restrictions. We don't think being short is unpatriotic, and so we've been short the S&P. We're only lightly that way recently since we've had this rally, but we still have a toehold negative S&P, and that worked very well for us in the first quarter, and I think it will in the future. And then short commodities. Copper is our favorite. Copper goes into almost any manufactured goods, whether it's cars, appliances, plumbing fixtures, machinery. And so copper is a very good indicator of global economic activity, and there's no cartel in the supply or demand side of copper. It's not like OPEC, where you can have a great forecast on the fundamentals, and then the Russians and OPEC come out with some announcement, and you're really in trouble. But copper, I think, is going to continue to decline, reflecting the excess supply, and that's what we're in. We're in an excess supply world, and that means probably more deflation rather than inflation. So that's basically the guts of our portfolio.
So, Gary, let me, if I could, just play devil's advocate for a minute, because I think we've got the 30-year U.S. Treasury bond yielding presently around 1.2, 1.3% last I looked, and you can correct me if that's not accurate.
Yeah,
so how can we see yields go lower when you think about a 30-year bond yielding, 1.2, 1.3%, has been below 1% at some point? It just seems like that's hard to justify, and I'm sure some of our listeners are thinking that. What's your rationale for that position?
Well, if we have deflation, and I think there is a good chance we'll move into chronic deflation. Let's say we have prices overall declining 2% a year. Now, if we had that, and you had a 1% yield on the Treasury, that would be 3% in real terms. If it were zero, it'd be 2% in real terms, and that 2 to 3% is the long-term average for real inflation-adjusted long-term Treasury yields. So it really depends where you go from here. Depends very much on inflation, deflation. There's a 60% correlation between inflation over the entire post-war period and long-term Treasury bond yields. So my justification for maintaining the long on Treasuries is the prospects of deflation. Also, in the intermediate terms, for the balance of the year and into next year, with I think a serious recession, it's a safe haven effect as well. I mean, people go for safe havens. I mean, you have people, you have people abroad who are going for the dollar, even though they're getting no return on it. So it's the same kind of thing. A safe haven is very important for a characteristic in investors.
So, Gary, let's talk a little bit about more government assistance, whether that goes, there's a bill now, I think, pending on the floor of the Senate that would pay each American $2,000 a month. Can you envision some response by the government, the Fed, or some combination thereof that would make you become more concerned about inflation and think that that's going to be the outcome versus deflation, or do you think that's just not a possibility?
Well, it is a possibility if we were to seal off the borders. We're in an excess supply world. You look at Asia. They are big producers. They produce a lot more than they consume. There's a savings glut, and that means with more production than there is consumption globally, that prices are declining. Now, in that environment, if we were to seal off the borders to imports, and we are getting more and more protectionist, there's no question of that, but if we were to go so far as to seal off the borders to imports, and then you have this massive monetary and fiscal stimuli, hey, they could overheat the economy, and they could create inflation, no question about it. But I think you would have to look at it as a isolated U.S. economy.
All right, I appreciate your perspective. So, what's your take on GDP? I'm seeing, I think Goldman and Morgan Stanley say we're going to see. I think they revised their forecast to a 38% decline quarter over quarter, second quarter of this year. How do you see it? I
don't spend a lot of time trying to divine those short-term numbers. I don't think it's a very fruitful exercise. Say that 20-30% annual rate decline for the second quarter, I wouldn't argue with that. It's the third and fourth quarter where I think we're going to see further declines and not this V-shaped recovery, which a lot of people, and I think many stockholders believe in, which would bring the economy well into recovery by the end of the year. I think it's not a V. I think it's an L, and I think we'll see the big decline now, but then further declines in the third and fourth quarter and into 2010. And if the economy for the year is down 8-10%, and that continues into next year, that wouldn't surprise me.
So where do stocks have to go for you to turn into a bull? Is that a fair question?
Well, if you look at the cyclically adjusted price earnings ratio put together by my good friend Bob Shiller of Yale, he got a PhD. He got a Nobel Prize for this and other work. If you look at that, where you are now, that price earnings ratio, and it's on the last 10 years of inflation-adjusted earnings, it's now 24. Long term, it was 17. Now, to get back to that long-term average, you'd have stocks decline 22%. Well, they won't stop there. If you get back to where you did at the low in 2008, you'd have a 40% decline in stocks from here. And if you want to get back to where you got previously at low PEs, which are more like 8, you'd have a 75% decline. In other words, you can see some pretty big declines. Now, those are PEs. And bear in mind it's the earnings to which you apply those PEs that are also important. And earnings are obviously collapsing. And another thing is you don't have stock buybacks, which were a strong supporter of stocks in the last 5 years. So I think when you put this together, it's pretty easy, almost optimistic, to see that the stock's further decline will only be 30 or 40% from here.
So, Gary, in the time we have left, what's your take on real estate? And if you could maybe break that down, seems like with all this work at home stuff that's got to negatively affect commercial real estate along with all the other factors we talked about. So what's your take on commercial and then residential real estate moving ahead?
Well, real estate is what they say, secret to real estate, location. It obviously differs. I think commercial real estate office buildings are going to be weak. You're going to have a lot more people working from home. If they're in the office, they're going to be more spread out, but probably on balance, more people from working at home is going to overcome that. The weakest sector, I think, are probably malls, because you've had the shift to online retailing for years, and that's really speeded up now. And a lot of people, I'm one of them, I found how many things I can order, and they arrive on the doorstep next day. And even if I could go to the store, it's a lot more convenient not to. So I think malls are very, very weak. Medical office buildings, that's probably going to be attractive with the aging, retiring post-war babies and their medical needs and reconfiguration after the virus. So those are areas I think of strength. Apartments are very interesting. I think there are a lot of people that are going to be in apartments in the foreseeable future, and that's what happened after the Great Recession. They couldn't afford single-family houses. The credit standards tightened up. They realized that house prices, for the first time since the 30s, nationwide had declined, and so you had a rush for apartments. And another interesting area, a couple of companies are involved in our ownership of single-family homes for rental. I think there are going to be a lot of people who are going to be moving out of cities to suburbs, And whether it's apartments or whether it's single-family rentals or even buying single-family houses, I think they're going to say, hey, I want to get out of the city. I don't want to be that close to other people.
Well, we're going to have to leave it there. Our guest today has been Dr. A. Gary Shilling. If you're just joining us, Dr. Shilling publishes the excellent newsletter Insight every month. We've been chatting with him about some of the topics in his May issue. If you'd like to learn more, you can go to agaryshilling.com or call 888-346-7444. Gary, always a pleasure to catch up with you. Always very much appreciate your insights and perspective, and would love to have you back down the road.
Well, I hope we can do it again, Dennis. I'll look forward to it.
As will I. We will return after these words.
I'm Dennis Tubbergen. You are listening to RLA Radio. Glad you're tuned in today. You know, in the first segment of today's program, I talked about the fact that we're going to have to see one of two outcomes, economically speaking, in my view. Because we have massive levels of debt in the private sector and also in the public sector, we will have to see a deflationary period of time, not unlike the 1930s, in my view. The alternative to that economic outcome would be that we have money creation continue in such massive amounts and in such massive quantities that eventually we see inflation or hyperinflation. And I've had very bright guests here on the program, many of which think we will see one outcome, many of which think we will see another outcome. Now, there are a lot of examples historically of money printing destroying a currency, so it's not as unusual as you might think. If you look at the recent examples of Zimbabwe and Venezuela, it's easy to see the results of socialistic free money for all. Currencies are destroyed, along with the hopes and dreams of savers who aspire to a comfortable retirement or maybe just a more comfortable life someday. Now, this is not economic theory. It's a statement of economic fact. You cannot study history and find one instance of any society or government printing their way to prosperity, whether the printing occurred via a devaluation of precious metal coins or through the use of a digital printing press, which is today's preferred method. Now, no matter your political leanings, if you have assets, this is a lesson that you definitely do not want to learn the hard way. Now, in the interest of brevity, I'll give you just a couple examples. In the early 1700s, John Law was the central banker of France. Mr. Law's legacy is that he destroyed the financial system through excessive money creation. Mr. Law was appointed central banker by the regent who was ruling France for Louis XV, who happened to be just 7 years old at the time. The first step that Mr. Law took when he became the central banker was to issue paper money that could be exchanged for precious metal coins that were used as currency at the time. Well, it didn't take too long, and all the coins were completely removed from circulation since paper money is a lot easier to use than our coins. Now, due to the massive amount of debt that France had after the death of Louis XIV, who incidentally was a very popular king because he provided a lot of free government benefits to his subjects, Law began to print more paper money than he had precious metals to back, a theme we often see. Eventually, once Mr. Law had created enough paper currency, France made holding the coins made from precious metals illegal. Franklin Roosevelt pulled a page out of John Law's book in 1933 when he made owning gold illegal for American citizens. Well, as the printing of paper money continued, it seemed for a time in France that prosperity was everywhere. Stocks soared. Shares in the now infamous Mississippi Company rose more than 1,000% in 1 year. Real estate prices soared. Luxury items were flying off the shelves in Paris. Eventually, as always happens with unbridled money printing, the currency failed and the French financial system failed. Now, undoubtedly, you've all heard and read and learned in history class of the failure of the German mark after World War I. Germany assumed that it would quickly win the war, which justified the temporary use of the printing press. See, almost always when money printing starts, it's temporary. At least that's what we're told, but that never ends up being the case. Remember back after the financial crisis when the Fed started printing $85 billion a month on a temporary basis? That conversation we used to have in billions is now taking place in trillions of dollars created literally out of thin air. Now, Germany was overly optimistic regarding the war's outcome. They thought they would temporarily use the printing press to win the war and then they would stop. Well, they printed money a little bit too quickly and inflation took hold. In fact, many historians believe that one of the major contributing factors to Germany's loss of the war was that a lot of the country's troops abandoned the military due to soldiers' wages not keeping pace with rapidly escalating consumer prices. Now, after the war, the size of the payments being required of Germany made them continue to print money, and the inflation problem just worsened and intensified. When World War I began, the German mark could be exchanged for a U.S. dollar at a rate of 4.2 marks per dollar. By the time 1923 rolled around, the exchange rate was 4.2 trillion marks per U.S. dollar. That's a devaluation factor of 1 trillion. Now, our current currency devaluation, because yes, we are on that slippery slope, began with the adoption of Keynesian economic policies. In his book, published in 1936, John Maynard Keynes said that, or theorized that, central banks and governments could play an active role in stabilizing economies by creating demand. That demand is now being created by printing money. Now, as we talked about briefly on last week's program, after World War II, the U.S. dollar became the world reserve currency because it could be exchanged for gold at a rate of $35 an ounce, very similar to John Law's arrangement where paper money could be exchanged for the coins containing precious metals. Eventually, Law did away with that convertibility, and the United States did the same thing in 1971 when the redemptions of U.S. dollars for gold were once again temporarily suspended. Since that time, the U.S. dollar has been a fiat currency, and history teaches us one other thing. Fiat currencies always fail, so we're not debating the what, we're only debating the when. Now, on my blog this week, which you can visit at DennisTubbergenBlog.com, I have a chart of the German mark priced in gold, and beside that chart, I have put a chart of the Federal Reserve's balance sheet, which really measures how much money has been created. I would encourage you to go to DennisTubbergenBlog.com and look at those two charts because they look eerily similar. Now, my point is this. As great as $10,000 a month sounds for a family of five or $4,000 a month for a couple, as is being proposed now in Washington, it will only accelerate currency devaluation. I'd encourage you to educate yourself. Go to our website, retirementlifestyleadvocates.com. Sign up for our newsletter, and certainly tune in next week. I'll have news about the release of my new book, Revenue Sourcing, which will share with you a strategy to use to plan your finances in the post-pandemic economy. That's all the time I have for this week. Thanks for listening. I'll be back again next week.